Hi, David. Thank you so much for coming to Investor Talk series. How's it going?
Hello, doing well, thank you.
Thank you so much for your time. Uh, just to brief our audience, the Investor Talk is a talk about how investors in venture capital invest their money. And why we do this? We do this because we want to educate our funders how to approach investors, how to talk to them, how to actually be prepared to talk to investors, right? So just don't go blind and without any kind of information what actually is the point of your investors behind investing. So as we start, would you like to give an introduction to yourself, who you are?
Sure. I'm David Mandel. I'm in the Los Angeles area of California. I'm currently the managing partner at Emerging Ventures Capital. We're a venture capital fund investing in seed stage tech startups in the US and Canada that are using emerging technologies to solve business challenges.
So in terms of sector and geography, let's start with geography. Do you only invest in Canada and US? So any startup coming from Euro, Asia won't be part of your portfolio, correct?
Correct. At this time, that is correct. Although in this global environment, it is somewhat common to see European or Asian startups that from day one want to be venture backable. They're building something that they want to scale with venture capital, and they have the foresight to incorporate as a Delaware C Corp, even though the entire founding team may be somewhere else in the world, and that's in this world that's okay. You have to look deeper. So what does it mean to be a U.S. startup? And is it where the founders are? Is it where they're incorporated? Is it where their customers are? Um, I mean, it's not enough just to set up a Delaware C corp, but it's a good start. And we have invested in several startups that um, none of the founders are in the U.S. and but they're global in their sales and they're a Delaware C corp and they have everything else set up correctly, meaning they have a brand name, venture recognizable U.S. law firm and accounting firm. And so we know that everything they're doing is being done to the standards that venture capital would want to see in the global markets and especially in the US. And that can go a long way. And therefore, you don't have to necessarily move to the United States to get venture backing here. Um, you can work from anywhere in the world. You can have customers anywhere in the world. But all your documents need to be in English, and you need to do accounting in US, banking in the US, and obviously be incorporated in the US.
You're right. I saw a pretty big trend of founders from Europe and Asia
Mhm,
incorporating directly in Delaware. Many of them having, as you said before, all the team, everything actually is outside except the law. They
mhm.
established in US in Delaware, and they run everything there from accounting to law. So it's a good news for them that venture capitalists in US look at also to this kind of structure that's put in this way. In terms of ticket, how much to invest?
We're a pretty small fund. We're now raising Fund 3. Our Fund 2 was only a $12 million fund, so we can't write very big checks. Our typical initial check was 250,000 or under, and then we've sometimes doubled down. So the most we have into any one startup is $500,000.
All right. So your investment is a pretty early stage. Investing in early stage startup, what actually is required for a startup to get your funding? What do you look the most? The team,
Mhm.
the idea, the product, the service? What exactly are you looking for?
So we're not as early stage as some others. We really don't go in pre-seed. Um, Even though some of the rounds we're in are technically considered pre-seed rounds, we look for um, we look for very solid early traction. We look for our whole underwriting in a nutshell is based on execution. Our theme is execution. So we look for a really three legs of the stool. We look for a live product and that customers are willing to pay for the product and that the team knows how to sell it to the right customers. So we look for solid early traction and a repeatable, scalable sales process. And we're coming in at the seed stage with the main idea looking at the future, saying, okay, with the money you're raising today, um, in 18 months, which is the average time between rounds, you know, will you be at Series A metrics, and who will write you a big check? You know, if you're raising 1.5 million on a 10 million valuation, say that's about the kind of average or median seed round now, right? If you're raising 1.5 on 10 today, and you're burning 100,000 a month, in a year and a half or less, you're going to need to raise a large round. And, you know, we're looking to 3 to 5x our valuation at each round. So what's going to make you worth $30 million in 18 months and be able to get a $5 to $10 million check from a large VC at that time? And kind of reverse engineer that, say, will you in less than 2 years be there? What would it take for you to get there? And what's the probability with what you're doing now and what you're planning that you can get there? And that's the big stumbling block for a lot of startups. A lot of startups can make a few initial sales. Let's say it's enterprise, and they can have founder-led sales where they use their relationship, they use their network, and they have a few great large customers. They have some great logos to put on their pitch deck. And as we dig deeper, we find out that, oh, well, that's your former employer, that's your co-founder's former employer, that's someone you know from college. So it's like, okay, you're selling to your network, but can you sell to others? Can you go beyond your network and have a repeatable, scalable sales process that can, with a pipe, show me the pipeline, show me the stage, and show me how you're going to really get from, say, you know, a 500,000 in ARR today to 5 million in ARR tomorrow. And that's where a lot of times it's just talk and numbers on a spreadsheet, a projection with nothing behind it. And no real pipeline, no real idea of where those sales are going to come from, no process in place to get there. And that's what falls apart. So, what we're looking for again, it's execution. We're looking for, go out there, build a product, sell the product, show me your customers are happy with the product, and show me that you can grow this to the next stage, where you can graduate from us and move on and raise much larger money at much higher valuations in the future. If not, that's obviously of no interest to us or anyone else. It might be a great small business, but it's not going to be venture scalable. And there's a lot of businesses that probably shouldn't raise venture capital. They should stay a small business, and there's nothing wrong with that. 99% of the businesses are just great small businesses and not meant to be venture scaled.
That's very right. I mean, there are so many founders that try to get into the venture capital path, but actually their business model is not done for venture capital because you need a very fast scaling company that allow you to exit one day. Otherwise, you can stick in the business for the next 10 years. I think founders, they don't understand the difference between shareholders and investors sometimes. They're not understand investors. They want the money back one day, pretty soon, probably sometimes, 2 3 years. And the head-to-head model is said to make sure that you can raise much more money after and give also to investors.
Right. Venture funds typically have a 10-year horizon,
Yeah.
and they invest for the first 3 to 5 years, and then they're harvesting after that the next 5 to 7 years. So, yes, when you're talking to a fund too, you want to understand where in the cycle they are, when did the fund start, and what's the maturity date, what time frame they're looking at. But typically, you're looking for a 5 to 7 year exit, so that the fund can then, these are all closed-end funds, and the fund eventually needs to be shut down and the capital returned to the limited partners.
Yeah. So my funders must understand the dynamics behind asking the money to investors. You are very right. In terms of investing, do you invest? Have you ever invested completely remotely, which means you never met the funders face to face?
Every day, ever since COVID. So it's almost 4 years now, right? In March it'll
Yeah.
be March 11th will be 4 days since we started doing everything on Zoom. And yes, when COVID first hit, there was about 2 to 3 months of shock where everything shut down. Accelerator programs stopped doing demo days. Investors weren't quite sure how to fund if they couldn't meet people. The stock market crashed. By May and June, it went back to business as usual. Um, all essentially every angel group accelerator program, university program, you name it, just flipped the switch and started doing everything through Zoom. And we started having um, all of our meetings, on Zoom with founders, and figured out how to do due diligence on Zoom, and with data rooms. And yes, I mean, it is great to meet founders in person, see their facilities if they have any, be able to meet the whole team a little bit, sit with the team for a few hours, have lunch with them, get to know them as people, build a relationship. It's a lot colder. I found that the relationship from those I funded on Zoom, which is everything in the last 4 years, is
Hmm.
not as warm. It's like I don't have as much of a personal connection with those founders as I do with the guys that, from say 5, 6 years ago that we did live, where I met them, I spent more time with them. The flip side is it's obviously much more efficient. There's no driving around LA traffic, there's no flying around the country. Or around the world in some cases to have to meet people, or but you know you can have 6 meetings a day instead of 2 meetings a day if you're driving. So, going out in Los Angeles in particular is essentially at least a half a day affair for anywhere to anyone if you're just going to have a meeting. And um, Zoom is like, okay, you get up and you have them back to back on your calendar, and you can talk. It's super efficient, and therefore I see that staying. I see that even now that we can meet in person, there's less of a sense of urgency to do so. I still don't see in person most of the founders that we fund. If I see them in person, it's because the opportunity was there, not because we required it or
Yeah.
uh, we're perfectly happy having introductions on Zoom, then having full due diligence on Zoom, and remotely, asynchronously with data rooms and email, and then funding them remotely. And if we happen to meet them someday in the future, great. And if we don't, that's okay too.
As I say, it's much more efficient, okay, for sure. But
Even board meetings for companies. If you're on the board, most
yeah,
board meetings are being done on Zoom now.
yeah, yeah, absolutely. Many of them. I mean, anyway, you can save a lot of time. You can do much more. That's totally true. Do you like having? I mean, after invested in startups, how many times do you like to meet them, even remotely, having reporting, make sure that things are going well?
Right. Um, it's nice to get a short monthly update with KPIs and a larger quarterly package that has full financials attached and so forth for our files, but just a dashboard. And every founding team should have a good dashboard already set up for themselves that they're looking at least daily, if not continuously, of whatever metrics are important to them. And it varies, if it's someone selling to large enterprise or someone having, where they have a few sales, and then it's about, versus someone who has, a mass subscription kind of business, and they're watching churn and watching different things. And um, but um, we really like to see just the monthly KPIs. Some only report that quarterly, and some I have to chase, and it's really never a good feeling when we have to chase founders to get updates. If I'm not hearing from them on a consistent schedule and I have to reach out because I'm going through and saying, I haven't heard from this startup last quarter. It's already February. I don't have a year end. I don't even know what happened in 2023. I don't have a Q4 update. And that is not good. And that would make me very unlikely to want to help them more in the future in some way, or especially financially. I would say, okay, they're not responsible. They only come to me when they want something. They come to me when they need help. They come to me when they want money. Otherwise, they don't want to talk to me. And and that's not smart from their side. It's like they should be proactively communicating with all their stakeholders and send out a decent looking formatted short update that is almost automatic. It's just their KPIs and whatever asks they have, and stay in front, stay top of mind with all their stakeholders, investors, and even those who didn't invest but wanted to stay in touch and said maybe next round. Just stay in front of everyone, give highlights of what's going on in the company, um, and your KPIs plus a few highlights like new hires or new special client or new project or any other things that are happening with the company, and just almost like a small little newsletter to all stakeholders. That's great to get. I read every one of them. If there's asks in there, I always try to help. So you can really leverage your community that way. And if you need a hire, if you have an opening, which many startups need to all the time, uh, put that in there and highlight it under asks. Oh, we have we need help hiring a data scientist. We need help with X. We're debating what to do on HR. Do you have any recommendations for a great outsourced HR vendor for us? Who should we use? And not doing that is a big loss. Investors see what everyone else is doing and can really add value. They even know that, say, another startup just laid off some people because they ran out of money. And and now you're saying you need to hire a data scientist. I might know a startup that just lost a data scientist. I might be able to connect them. If I don't know, I can't help.
That's correct. I mean, Behead, it's huge help, and in somehow give you a very clear picture who they are, right? If they're very committed, not only to the business but to the investors themselves, and to the shareholders, stakeholders, all the things around. Uh, you say already a bit, but how do you help founders after investing? Do you have, for example, if they have another round, are you helping them to give some connection with your network?
So the short answer is yes. We help in a lot of ways, a lot of them invisible, because like I said, we'll see their asks on their monthly updates and often be able to add something here and there. We'll see that they're struggling with something or that something, and we'll schedule a call to say, hey, I can help with that. I saw how someone else is doing it. Um, and particularly, say, in these last year and a half, when it's been kind of tough times, I spent a lot of time giving advice to founders of how to structure a bridge round and what they should do to send, because they would send out updates just saying, hey, we're running a little tight and we're considering raising a bridge. If you have any interest, contact us. And I was like, no, that ain't going to work. You really need a process and you assess an urgency. And they don't know what best practices are for that. They've never had to raise a bridge round ever in their life. I've probably seen 100 of them just in the last 6 months because everyone's raising. So I've seen the good and the bad. I have a lot of advice about what's working, what's not working, and they'll give them some best practices and help them shape their next. So help them shape that all the way from that to, like you said, when they are officially raising their next round. We all keep relationships with other VCs. I have quite a large list with very unique, especially down to exactly what geography, what stage, what specific products they like and don't like. Are you just enterprise SaaS? Are you just drones and robots? Are you just AI? Are you a generalist? Do you want to lead? Do you want to follow? So forth. I know all of that. I know what they've invested in. Most of those relationships come from prior portfolio companies that raised new rounds. And as they're raising the rounds, we were already on the cap table and we spoke to them. And that's another area. So we build the relationship, and then they're happy to hear from us because they funded one of our portfolio companies. They're happy to hear when we have another. They know that we know them and they like what we invested in. But
Hmm.
a lot of times before that, I they'll see me on the cap table, and I'm often in on early rounds. And there may be other VCs on the cap table. There may not. The other rest of the cap table may be angel investors or other type of universities or groups or whatever. And so I'll often get a call, or they'll reach out to me somehow, LinkedIn, email, wherever. If they know me or don't know me, they'll reach out to me and say, hey, we're considering, we're talking to this startup, we're considering making an investment. We want to talk to you about them. So I'm often a reference to these startups to explain to the potential new investors for the larger round how they've been with me. So I'm a character reference and an investor reference to say what I like about them and how they've been behaving, whether say they've been reporting monthly correctly and all that, and do they do what they say they're going to do, uh, you know, and just are they trustworthy as founders? I often spend a lot of time talking to potential investors in the next round of our portfolio companies, often, sometimes introduced by the founder, but more often than not, without the founders even know I'm doing that. The next one, they'll reach out to me and I'll be happy to jump and try to find the first slot I can to talk to them and give information about a founder and a startup and what I like about them as a reference to the next round.
Do you like co-investing? Do you co-invest? And if yes, do you lead or preferably follow-up investment?
Good question. And we write smaller checks. Um, so it's harder to lead, but we can. And especially now, more and more rounds, the lead is writing less than half the round. So it's okay to do that. So if I really like a startup and they don't have a lead and they want it to be a priced round, I may offer to lead and write them a term sheet so they can do a proper priced round. If a round is not a priced round, if it's on safes or convertible notes, there is no need for a lead. And that's
Hmm.
another place where I help educate the founders because they keep saying, oh, we have a lot of interest um, to follow on. We're just waiting to get a lead. And it's like, if you have interest, start taking their money. Uh, don't wait for a
True.
lead. And they sometimes
True.
just really don't understand that they can do that. They think they have to get a lead. And if they're coming out of an accelerator, then they know that. The accelerators teach them to raise on safes even during the program and how to do all that. But
Yeah.
if they're not coming out of an accelerator and they're a first time founder, they really don't understand that. They may have had some pre seed safes from some small angels or friends and family, and now they're trying to raise something bigger, and they keep saying, "Oh yeah, I have like five people each saying that they'll follow. They'll give me, 100, 250. I already have a half a million soft circled, but I need a lead." And it's like, why do you think you need a lead? And you know, as I explained to them, like I say, most of these rounds don't have a lead, especially in these times, and that's okay. If you have someone that wants to write you a $250,000 check, take their check, give them a safe. Uh, should someone come around that wants to lead this as a priced round and you accept their term sheet, then that's great. All these safes will convert and everyone's happy.
Yeah.
And if you don't get that lead, you just keep on going around and collecting all these followers and you're taking these safes and you fill the round, then you stop. You're done and you filled
Correct.
the round. And it's not a priced round, then that's okay. And hopefully the next one will be, and everyone will convert. But in these times, don't wait for a lead, especially not at the seed stage. I mean, Series A is a different story. Those are bigger checks, and and you'll want it to be a priced round at some point. On the flip side, some of these founders get kind of hooked on the safes and raise round after round after round on safes and don't even try to do a priced round, and then no one ever converts, and they don't get the proper governance, and that's a different problem. That's the other side of the problem. But for your first round, definitely, don't wait for a lead. Just take the money. Anyone out there that's hearing this, that needs to hear this, that's trying to raise, uh, if that helps in any way, definitely don't wait for a lead. If someone wants to give you money and say, "Oh, well, we follow, we don't lead. Let me know when you have a lead," just immediately flip the conversation and say, "Okay, how about we just do a safe today?" And if we get a lead, you can convert. If we don't get a lead, it stays as a safe, and we'll fill the round. And that's how you know if they're really serious. Are they selling you? You might think you have 500,000 soft circled, and it might all be nothing, because the easiest way for a VC to say no is to say maybe. And uh, and to give you another hurdle to jump over and make, and so it's easy to say, well, oh, that's great, but you don't have a lead yet, so I'm interested. Just let me know when you get a lead, and then we'll take a look at it. And sure, it costs nothing to say I'll take another look at it. And when there is a lead, depending on the lead and the terms, it might want to take another look at it. And I've said that many times myself in deals that I wouldn't commit to without a lead, and without the due diligence being done and so forth. And it's a little early, and I'm worried about them being able to raise enough. That's an easy answer to say, you know, well, we follow, we don't lead, and we'll just wait for you to get a lead. But just turn that around and say, well, we're not going to have a lead for this round. We're just collecting safes, and I'm happy to convert it to a priced round if you or someone else wants to lead, but if not, it'll fill up. I have enough interest. I'm going to fill this on safes, and it will be done we're finishing by March 1st. So are you in or are you out? And that changes the conversation.
That's a very good advice. Many found that they don't know. Some of them don't even know what is a safe, but it's pretty much understandable. As you said before, you must be educated, right, in this kind of stuff, how venture capital works. I had to say, based in Europe, safe notes are still not that there. This because many countries, they do not even allow you to have a safe note, as they do not allow you to have a very stock option, as must be. So it's a very difficult in Italy when you start. Now it's more common. Up to just a few years ago was very difficult. And many founders in Italy, David, they still raise the money in convertible loan note.
Yeah,
Yeah.
convertible note, same idea as a safe, essentially. Not the place to get into the technical differences, but yes, that works too. And doing, I mean, doing a priced round, but self-circulating it, self-leading is also a thing.
Mhm.
It's less common, but I have seen and even participated in rounds that were, in a sense, founder self-led. The founder put together their own term sheet. Their attorney created all the subscription docs, and they're just circulating that. It's like, here's the terms, here's what we're raising, and this is the round. There is no lead, but we have so much committed already, and they just keep on going around taking subscriptions. That in times where it's harder to get someone to step up and lead, that's also an option. But in the US, it is very common now to just do those on safes instead, especially if the round is smaller, uh, and to wait for there to be a negotiated larger priced round to convert into eventually, and not to do very small rounds as priced rounds. Although I have seen it, and I've seen the ones where there was no lead per se. There was no negotiated term sheet with a lead VC. The term sheet was actually set up by the founder.
It makes sense. Anyway, I'm completely with you. The best way to raise money in the very early stage is safe. Indeed. Less problems. You don't need to price your startup and leave the job to the one who knows probably better than you when the day will come, right? And maybe you get even a better price. You never know. How do you, I mean, mm, do you, in your portfolio, do you sometimes put together the startup? Say, for example, one has to sell and one can be a customer. They can have a good introduction between them. So do you give this kind of interaction between them?
Oh, for sure. I'm always playing matchmaker. I'm always connecting founders to each other. If they're in similar but yet non-competing businesses, I would always like them to meet, of course, with a double opt-in if they're both interested. because it's lonely being a founder and having a peer to speak to is helpful. Um, One thing I realized a while ago actually is that founders spend too much time trying to network with customers and investors, not enough time trying to network with other founders. Um, and it's important for them to network with other founders and build a peer group, and that they can just be friends with, share best practices with, run problems through, and so forth. It's almost like being an advisor to each other. And like you said as well, to answer your direct question, yes, if one of our startups can be a vendor or a customer, or a partner in any way to any other portfolio company, obviously we'll connect them.
Can you tell, for example, funders are very not reluctant, but they many times they pivot too late when times arrives, and the consequence is failing because if you don't pivot, means you need pivot to pivot, and probably you will fail. Uh, how can you advise them to understand if the right time to pivot is there? And you need to. There is no way you can't wait even a day more, otherwise you will die because the cash will finish.
Right? That's a tough one. There is no right time to pivot. It's when the founders, I mean, the ability to be nimble and experiment, and which at the end translates into pivoting once you find what works, uh, is an important trait of a founder. They need to be open minded. You can't just have a plan and say, I'm going to execute my plan. You need to have a plan, but you need to be very flexible and curious and constantly experimenting until you figure out what's working. You try selling 10 different ways to 10 different types of customers to see eventually where it takes off. And it's often a surprise which type of customer eventually wants your product, and at what price points is something that you won't know. And if it turns out to be that it's actually they only want it not for your original idea, but they want it because of a particular feature that was an afterthought, and now you're focusing on that, and you're going to, in a sense, pivot to make that your main product. That's perfectly fine. Now, I've seen many startups that say start thinking they're going to go after small and medium businesses as their entry point and eventually go to enterprise, just to find out that actually they're a much better fit for enterprise and they're not a fit for small business. That's quite common, that their product is small businesses don't appreciate it. And then they pivot, and maybe instead of trying to do enterprise sales, they come up with a grounds up approach of trying a freemium model. So employees of large enterprise can use their product for free, so that they become ambassadors for it, and eventually they'll get the large contracts. I'll see that all day long where I talk to founders and they're like, oh, yeah, we have customers, we have Microsoft, we have this, we have that. It's like they actually have contracts with you. And they'll be like, well, not exactly, but we have them using our product because we have a freemium model and we have employees, and but they can put those logos on their deck of as customers of theirs because they are customers of theirs. Uh, and they might, have a small freemium kind of seat license where they might want $100,000 a year kind of enterprise contracts, but they might be happy now to start with like a free model that you can then upgrade to a $29 a month model for an individual user without any of the enterprise features. And that's how you find out what features the people really want, what they're using, how they're using your product, which employees within the organization use your product. And often it's a surprise. It's not the teams that you thought are going to use it, and they're not using it the way you thought they're going to use it, but you're getting thousands of people to use it, and you've learned from them how they want to use your product. So yes, that's a different maybe answer to pivoting, but that's how I see pivoting. I see trying, experimenting over and over to see what works, and very often the final product. I mean, I believe even many successful companies today of the biggest unicorns out there were pivots. They are the product that they eventually scaled was like a small feature
Yeah.
of their prior product, which they thought was going to be their product. And eventually they often even changed their name and everything else, because what they're really selling is not at all the vision that they thought of initially, but turned out to be what people didn't like their main product, but they like X. They want that one little feat. And then, if you turn X into your new product and forget about your original product, then you can be successful.
That's very true. What do you like to see in a pitch?
Less, okay, this might be different than what some other founders, other investors say, but I like to see less about the problem, uh, and more about you and your history, and and how you're solving it, and what's unique. And what I mean is, like, if you're sending your deck to the right investors, let's say you're doing something with climate change that's going to help the environment. I don't need 10 slides on the global problems of climate right now. It's like, if we don't know that, you shouldn't be talking to us. Or in my case, or let's say it's an AI startup. I mean, explaining, you know, the growth in AI and the potential market for AI and why every business is going to want AI, and having, like, 10 different slides explaining how AI is here and why AI is important for businesses. It's like, okay, obviously I know that if I'm an AI investor. So I don't need a documentary on why AI is important, and tell me about you, your team, your backgrounds, what particular niche problem you're trying to solve, and why are you uniquely qualified to solve this problem better than anyone else, and what is your unique value proposition? What are you offering that is so unique that the competition can't offer, and so forth. So, because too many completely miss actually that. I can read an entire 20, 30 slide deck and learn nothing, other than they claim AI is a big market, and that, and therefore, if they only get 1% of that market, they're going to be billionaires. And it's like, yeah, okay. And what exactly are you doing? I read it, I have no idea what they're doing or why they're better than the other 10,000 AI startups out there. So, because it's like, nobody's the only one that can do something in their field, but very few exceptions. And so it's really, don't do that. Do tell me more about you, why you want to solve this problem, how you're targeting that problem, why you're uniquely qualified, and then tell me about how you're getting customers and how you're going to get your next customers, and how you're thinking about that, and how you think looking at margins and everything else, and tell me what really matters. I don't need to see the, if it's obvious, then leave out the backstory of the industry and leave out the addressable market, and definitely don't say things like, you know, if I only get 1% of the market, this will be $1 billion company in 5 years. That's a big turnoff.
They all do
That's
this.
completely not helpful. Yeah, that's completely not helpful. That just shows me that you've given no thought to how you're going to get your customers, what your particular niche is going to be, and why they're going to get. Now,
It's very
yeah,
common. It's very common, David, to say this. Very, very common. 99% of the time.
right.
Yes.
Yeah. And another big thing, I mean, do say be as specific as you can without giving away anything confidential. And um, don't ask for too much either. Be clear about what you're asking for and how you're going to use it. Like, I'm raising 1.5 million for 18 months of runway to get us to our Series A metrics. I would love to see someone say that. Um, you know, and but um, if someone has oh, we just launched 2 weeks ago and we have our first 3 customers and now we're raising $5 million. It's like, to scale. It's like, no, that's a big turnoff. You don't need $5 million today. Well, I don't know what your burn rate is, but what would you do if I gave you $5 million? Uh, it's like, they say, oh, I'm raising $5 million to scale. It's like, why? Because you got 3 customers that were probably your friends. I mean, how? It's like you're probably not even worth $5 million. If you started this 3 months ago and you built something, why are you even, if you're raising 5 million, then it implies you want a valuation of like 20 to 30 million dollars. And I'm just not going to call you. I'm just going to delete that deck because there's no way you're worth 20 to 30 million dollars. You're probably not worth five. So if you say, that that that's a big mistake, I think. Not being clear about what you're going to do with the money, and not being clear or how long, and asking for too much. There's two completely different things, but those are both big mistakes that are complete um, deal killers. If I see a deck with that, I will delete that deck, and uh, you'll not get a meeting with me, um, because it tells me that you're just thinking about it wrong, and I just don't want to have to take the time to educate you about why you're thinking about it wrong when I don't even know you.
that's a that's a good assumption. How founders should approach investors, in your opinion?
Very targeted, and it's always quality over quantity. It's the same thing I say for myself when we're fundraising. Everyone comes to me and says, "I can get you a list of 10,000 family offices." It's like, I don't want 10,000 family offices. I want two. If you can introduce me to two as a warm introduction that really that understand what I do and are interested and want to talk to me, I'll be much happier than with 10,000. And it's the same thing for everybody. It's quality over quantity. You don't necessarily want to bombard the world. You want to find the right investors that might invest in what you're doing at your stage, and then find a way to get a warm introduction to them. So, use your LinkedIn, use whatever connections you have to get a warm intro somehow from another, and that's where founder networking matters. Because if you're, say, a drone startup, and you network with other drone startups, with founder, you take the time to meet founders of other drone companies and build a relationship with them. Not the minute you want to fundraise, but like a year, way before that. And you guys share everything. You're talking to each other monthly, talking about all the challenges. Then, as soon as one of you raises a round, you're going to refer the other to the same VC or the same group of investors. You might have now 8, 10 investors that came in on a seed round. You're going to tell your friend who just raised a round. And I'll tell you, most of my best referrals come that way. There are other founders, even sometimes founders that I didn't invest in, but I spent some time with, I did diligence on, at the end passed on. They'll often now, a year later, 2 years later, 3 years later, refer me another founder who is possibly a good fit. And I will, because they're sending it to me saying, "Hey, you remember me? We did this, we did that. I remember why you didn't invest in me, but here's a friend of mine that has a startup that I think is exactly for you. I want you to meet him." I'll be happy to meet them very instantly. Uh, any portfolio company founder that's sending me another startup, I'll always talk to them. Um, and the same thing, anyone I co-invested with, I'll always take their referrals. So if you get one investor, ask them for referrals, and it could be an angel investor, but ask them for referrals to their network, to anyone they've co-invested with before. It's like, who else in your network do you know that is invested in these kind of startups? Who else have you co-invested with before? Because no one invests just once. Everyone invests in a large portfolio. So they will want introductions. And yes, it has to be warm referrals. Occasionally, cold inbound works. I get more than 30 a day on average cold inbound. A lot of times it's a lot more. Um, Emails, LinkedIn, some very specific, some just blasts. I don't even count the blasts, but uh, very few turned into anything. Um, and I mean, it's like, I don't do life sciences. I still, probably a quarter of what I see today. It's gotten better, but like a quarter of what I see today is life sciences. It's like you know, it's someone curing cancer. I see that 10 times a week, and I wish it was all true, but and they're all smart people, but I can't tell that apart. Have no background in life sciences, so I just don't do that. And if you take a few seconds to look at my profile, our website, it'll be clear that we don't do that. And yet I get pitches for, like, biotech and medical devices and all kinds of other life science type of startups every day. So, that's people that are just not even taking the time to just sending it. They're looking at it as a numbers game, and it's not really a numbers game. It is quality over quantity. And yes, still after that, it is a numbers game. You're going to hear 100 no's for every yes. And you
That's
have to
good.
keep getting more referrals, get more meetings, and give more pitches, and you get better at it. Your pitching gets better. You learn to tell the story better. You learn, you can tell when you're talking to a founder who's pitched a lot versus a founder who's just starting to pitch. They get a lot more polished over time.
The difference is massive. Do you invest in startups that don't have the IP as a property belonging to them, not protected? Maybe they need.
Um, in software, there's little IP. So the answer is yes. And um, I mean, if there is anything if there is any IP, you have to obviously trace it to make sure they have a right to it. If they licensed it from a university or whatever. But should they get patents? Not necessarily. Patents can, at the early stage, can be a distraction, but that varies so much. That varies by exactly what you're working on and how proprietary it is and so forth. Um, with software, no, don't bother to get patents. You can't really it's really, really hard to patent an algorithm, or to patent code of any kind. On the other hand, the other extreme, so I do only invest in technical founders. If I'm investing in a technical startup, I want the CTO to be a founder. That's a hard rule for me. I don't think you should outsource that. You know, I don't think a founder here who is a chief revenue officer for some other startup wants to go start his own startup, and he's a sales guy, and if he doesn't value, and he's creating another very technical product, but if he doesn't value the technology that way, he thinks it's just something he needs to buy, then I don't like that. So if they're like, if the entire tech team is outsourced, including the CTO, then that's a big red flag for me. So I don't care about the IP being, I mean, I don't care about them having patents if it's not applicable. I do care about them owning their technology. It has to be theirs. It has to be proprietary. Um, if you're some sales guy and you think AI is cool and you're going to make a startup that basically is using OpenAI or some other, third party to do something for a certain vertical, I'm not that interested, because you're really not, you know, I mean, you're just a sales guy packaging, somebody else's product. It's not, it's not a tech startup.
That's correct. Let me close with where do you see the money going 2024, 2025? Let's don't talk about AI because AI is the tech, is the technology behind. But where do you see where are the industries? Let's put it in this way: the sector industry that will get more funding in the coming, let's say 2024, 2025 is too far away.
Yeah, good question. And I mean, I focus a lot on enterprise, and it is because of all the new wave of technology. Just about every business now is due for a refresh, so they're actually open to it, and that's exciting times. So as a founder, I think you want to go narrow. You want to solve a particular niche problem for a particular industry, and it should be something that you understand or somehow stumbled upon or your co-founder understands, and go dig in on that and create something using current emerging technologies. Take the most cutting edge technology and adapt it to a use case for a particular industry, because every industry today wants new technology. They know that they're falling behind if they're not keeping up. They're seeing this pressure in the media about really AI. This co-pilots for everything. So like you're saying, AI is the technology. The industries is essentially any enterprise, but you have to understand that business to even know that there's a need there. And if you come from the real estate business, do something for realtors. If you come from an accounting background, do something for accountants. If you come from the insurance industry, do something for insurance. And I've seen that be successful. I've seen founders often partnering. You'll have a genius technical guy partnering with a business guy who comes from a certain industry, has certain background. Maybe their family was in a certain background industry even. Uh, and it's like, okay, yes, my family was in clothing manufacturing and I saw how primitive that is, and they can really benefit from these new technologies. So they go partner with a CTO and they build something for clothing manufacturers, for example, or for the automotive industry or whatever. So building something industry specific for any industry uh, using the modern technologies has great potential to be successful and get funded. You really do have to be solving a unique problem. Like you said, you can't just say we're offering AI. It's like that's not good enough. Every startup today is an AI startup, just like every startup 20 years ago was a database startup
That's
or an
correct.
internet. Oh, that was 30 years ago, and then 20 years ago, every startup was an internet startup. No one says today they're an internet startup. It's assumed that you know things are delivered through the internet. And the same thing they were saying already since last year. It's like every technology startup today is an AI startup. It's just going to be one of the tools you use. Everything you're going to be using AI, and it's going to be an invisible behind the scenes part of every tool now. So like you said, yeah, you can't just say you're an AI startup. You have to say like we're using it, we're a cutting edge SaaS platform to make the life of tax preparers easier. That would work. I'm making the life of realtors easier. I'm making the life of librarians easier. I don't care whose problem you're solving. It could be software for liquor stores, for clothing stores, for restaurants. There's obviously been a lot of restaurant tech coming out there for every side of it. Um, but solve someone's problem, provide and start with one kind of small niche solution and eventually expand and add on within that same industry, the land and expand. Start with a niche product, solve one little problem that they're seeing, and eventually expand until that's a whole suite and they can do everything on your platform, but initially solve one little problem. Uh, we've seen that over and over and over be successful.
David, thank you so much for coming to the Investor Talk series. It's been a very good pleasure for me. Thank you so much for your time.
And thank you. This has been fun.
Thank you.